Hello, and welcome to another Read With Me session. I'm yours truly, Isabel Bedell, and I'm here to read with you The Psychology of Money. We are in chapter 16, You and Me, You and Me. This is going to be an interesting chapter. I'm really excited for it. And I'm really excited for the fact that we're almost done with this lovely little book here. This final week, we're going to be ending this book and we're going to get into the next book for financial freedom. And if you have not had the chance to take a look at the previous videos, I recommend to look at chapter number 7, which is the freedom chapter. Fantastic. One of my favorite chapters. Another one was Wealth is What You Don't See. Fantastic chapter as well. Another one is Save Money. It's completely different than what the title says. So if you are in a space where you are conscious about your financial health, your financial wealth, your financial abundance, this book is definitely a book to keep in your library. And I'm really grateful that we took advantage of this opportunity to read with you. So without further ado, You and Me, chapter 16, beware taking financial cues from people playing a different game than you are. The implosion of the dot-com bubble in the early 2000s reduced household wealth by $6.2 trillion. The end of the housing bubble cut away more than $8 trillion. It's hard to overstate how socially devastating financial bubbles can be. They ruin lives. Why do these things happen? Why do these things keep happening? And why can't we learn from our lessons? The common answer here is that people are greedy. And greed is an indelible feature of human nature. That may be true, and it's a good enough answer for most. But remember from chapter 1, no one is crazy. No one is crazy. People make financial decisions they regret, and they often do so with scarce information and without logic. But the decisions made sense to them when they were being made. Blaming bubbles on greed and stopping there misses important lessons about how and why people rationalize what in hindsight look like greedy decisions. Part of why bubbles are hard to learn from is that they are not like cancer, where a biopsy gives us a clear warning and diagnosis. They are closer to the rise and fall of a political party, where the outcome is known in hindsight, but the cause and blame are never agreed upon. Competition for investment returns is fierce, and someone has to own every asset at every point in time. That means the mere idea of bubbles will always be controversial because no one wants to think that they own an undervalued asset. In hindsight, we're more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why wars occur. There are almost always several reasons, many of them conflicting, all of them controversial, and it's too complicated a subject for simple answers. But let me propose one reason they happen that both goes overlooked and applies to you personally. Investors often innocently take cues from other investors who are playing a different game than they are. An idea exists in finance that seems innocent, but has done incalculable damage. It's the notion that assets have one rational price in the world where investors have different goals and time horizons. Ask yourself this: how much should you pay for a Google stock today? The answer depends on who you are. Do you have a 30-year time horizon? Then the smart price to pay involves a sober analysis of Google's discounted cash flows over the next 30 years. Are you looking to cash out within 10 years? Well, then the price to pay can be figured out by an analysis of the tech industry's potential over the next decade and whether Google management can execute on that vision. Beautiful way to put analytics into use. Beautiful way. Are you looking to sell within a year? Then pay attention to Google's current product sales cycle and whether we'll have a bear market. Are you a day trader? Well, then the smart price to pay, who cares? Because you're just trying to squeeze a few bucks out of whatever happens between now and the lunchtime, and which can be accomplished at any price. When investors have different goals and time horizons, they do in every asset class, prices that look ridiculous to one person can make sense to another, because the factors those investors pay attention to, they're different. Take the dot-com bubble in the 1990s. People can look at Yahoo stock in 1999 and say that was crazy, a zillion times revenue. The valuation made no sense. But many investors who owned Yahoo stock in 1999 had time horizons so short that it made sense for them to pay a ridiculous price. A day trader could accomplish what they need, whether Yahoo was at $5 a share or $500 a share, as long as it moved in the right direction that day. And it did for years. An iron rule of finance is that money chase returns to the greatest extent that it can. If an asset has momentum, it's been moving consistently up for a period of time. It's not crazy for a group of short-term traders to assume it will keep moving up, not indefinitely. And just for the short period of time, they need it too. Momentum attracts short-term traders in a reasonable way. Let's highlight that. Momentum attracts short-term traders in a reasonable way. Then it's off to the races. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. That process feeds on itself. As traders push short-term returns, they attract even more traders. And before long, it is often doesn't take long, the dominant market price setters with the most authority are those with shorter time horizons. Bubbles aren't so much about valuation risings. That's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. And that's, ladies and gentlemen, what's currently happening right now in the crypto market. There's so much volatility right now. With everything that's happening, we've literally gone through a couple different scenarios within crypto. And there's a lot of short-term traders right now entering the market, and you can tell from the spikes in all of the candles when it comes to, like, let's use Bitcoin as an example. If you take a look at what's happening now, a lot of people are entering the market, but they're also exiting the market. And then the people that enter and get out, that is a short-term sales process or sales cycle, because they're short-term traders. They're making a lot of money, but they're going back to the previous chapter, they're going to be paying a lot of fines to play that game, right? So it's up to you. You have to make a decision of who and what type of trader, what type of investor, what type of economist you want to be, and how you want to manage your wealth. It's common to say that the dot-com bubble was a time of irrational optimism about the future, but one of the most common headlines of that area was announcing record trading volume, which is what happens when investors are buying and selling in a single day. Investors, particularly the ones setting prices, were not thinking about the next 20 years. The average mutual fund had 120% annual turnover in 1999, meaning they were, at most, thinking about the next 8 months. So were the individual investors who bought those mutual funds. Mani Mahar wrote in her book, Bull. By the way, the book is called Bull, like bull market. She writes in her book, by the mid-1990s, the press had replaced annual scorecards with reports that appeared every 3 months. The change spurred investors to chase performance, rushed to buy the funds at the top of the charts just when they were most expensive. This was the era of day trading, short-term option contracts, and up to the market commentary. It's not the kind of thing you'd associate with long-term views. The same thing happened during the housing bubble of the mid-2000s. It's hard to justify paying $700,000 for a two-bedroom Florida tract home to raise your family in for the next 10 years, but it makes perfect sense if you plan on flipping the home in a few months into a market with rising prices to make a quick profit, which is exactly what many people did during the bubble. The data from Adam, a company that tracks real estate transactions, shows the number of houses in America that were sold more than in a 12-month period, and they were flipped, rose fivefold. Those houses that were flipped rose fivefold during the bubble, from 20,000 in the first quarter to 200 to over what? Hold up. Let me start from the beginning here. Data from Adam. Adam is a company that tracks real estate transactions. It shows the number of houses in America that were sold more than in a 12-month period. So they were actually flipped. So it tracks flipped houses. In the first quarter of 2000, 20,000 were flipped. Okay. And then 100,000 were flipped in the first quarter of 2004. So in a 4-year time span, in the first quarter, it rose from 20,000 to 100,000. Flipping plunged after the bubble to less than 40,000 per quarter. Wow. Where it's roughly remained since. Do you think flippers cared about long-term price to rent ratios, or whether the prices they paid were backed up by long-term income growth? Of course not. Those numbers weren't relevant to their game. The only thing that mattered to flippers was the price of the home would be in the next month than it was this month. And for many years it was. You can say a lot about these type of investors. You can call them speculators, you can call them irresponsible, and you can shake your head at their willingness to take huge risks. But I don't think you can call them irrational. The formation of bubbles isn't so much about people irrationally participating in long-term investing. They're about people somewhat rationally moving toward a short-term trading to capture momentum that had been feeding on itself. What do you expect people to do when momentum creates a big short-term return potential? Sit and just watch patiently? Never. That's how the world works. Profits will always be chased. And short-term traders operate in an area where the rules governing long-term investing, particularly around valuation, are ignored. And because they're irrelevant to the game being played, that's where things get interesting and where the problems begin. Bubbles do not damage when long-term investors playing one game start taking their cues from short-term traders playing another. Cisco stock rose 300% in 1999 to $60 per share. At that price, the company valued at $600 billion, which is insane. Few actually thought it was worth that much. The day traders were just having their fun. Economist Burton Malkiel once pointed out that Cisco's implied growth rate at that valuation meant that it would become larger than an entire US economy within 20 years. But if you were a long-term investor in 1999, $60 was only the price available to buy. And many people were actually buying it at that price. So you may have looked around and said to yourself, wow, maybe these other investors know something I don't. And maybe you went along with it. You even felt smart about it. What you don't realize that the traders who were setting the marginal price of the stock were playing a different game than you were. $60 a share was a reasonable price for the traders because they planned on selling that stock before the end of the day, and when its price would probably be higher. But $60 was a disaster in the making for you because you planned on holding shares for the long run. These two types of investors rarely know that each other exists, but they're on the same playing field, running towards each other. And when their paths blindly collide, someone gets hurt. Many finance and investment decisions are rooted in watching what other people do and either copying them or betting against them. But when you don't know why someone behaves like they do, you won't know how long they'll continue acting that way, what will make them change their mind, or whether they'll ever learn their lesson. When a commenter on CNBC says you should buy this stock, keep in mind that they don't know who you are. Are you a teenager trading for fun? Are you an elderly widow on a limited budget? A hedge fund manager trying to shore up your books before the quarter ends? Are you supposed to think that those three people have the same priorities? And that whatever level a particular stock is trading it at is right for all three of them? It's just crazy. It's hard to grasp that other investors have different goals than we do, because an anchor of psychology is not realizing that rational people can see the world through a different lens than their own. Rising prices persuade all investors in ways the best marketeers envy. They are a drug that can turn value-conscious investors into dewy-eyed optimists, detached from their own reality by the actions of someone playing a different game than they are. Being swayed by people playing a different game can also throw off how you think you're supposed to spend your money. And so much consumer spending, particularly in developing countries, is socially driven, subtly influenced by people you admire, and done because you subtly want people to admire you. But while you can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, aspirations. A young lawyer aiming to be a partner at a prestigious law firm might need to maintain an appearance that I, a writer who can work in sweatpants, have no need for. But when his purchases set my own expectations, I'm wandering down a path of potential disappointment because I'm spending the money without the career boost he's getting. We might not even have different styles. We're just playing a different game. It took me years to figure this out. A takeaway here is that few things matter more than money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing a different game than you are. The main thing I can recommend is going out of your way to identify what game you're playing. It's surprising how few of us do. We call everyone investing money investors like they're basketball players, all of them playing for the same game with the same rules. And when you realize how wrong that notion is, you see how vital it is to simply identify the game that you're playing. And how I invest my own money is detailed in chapter 20. But years ago, I wrote out that I am a passive investor, optimistic in the world's ability to generate real economic growth. And I'm confident that over the next 30 years, that growth will accrue into my investments. This might seem quaint, but once we write that mission statement down, you realize everything that's unrelated to it. What the market did this year, or whether we'll have a recession next year, it's part of a game I'm not playing. So I don't pay attention to it, and I am in no danger of being persuaded by it. So let's talk about pessimism. Okay, and this is the Seduction of Pessimism, chapter 17, which I feel like a lot of people might have it more stronger than others. So this might be a chapter that can help you when, attracting new opportunities coming into your life. And I say that for you, and I say that for me as well. I'm really excited to read into that. And this chapter alone, I feel like now more than ever, people really need to really look at what game they are playing, asking themselves, what game am I playing? We're part of a couple different masterminds, and some people in there are like investing like 6 figures every week, which is awesome, but that's their game, and they're willing to lose that. Just like that, we've seen it happen. That's not a game that I'm willing to play, at least not now in my career, in my life. I've lost enough to understand that's not my vibe. That's not my game. And that's definitely not the game that I'm willing to sustain long term, which this book has actually helped me understand in a deeper sense who I am. What kind of investor am I? What do I like? What do I not like? and how to ask myself certain questions so I can make reasonable and rational decisions. I hope you got a lot of value from this chapter. I know I did, and I'll talk to you soon. See you later. Check out the other chapters, and I'm sure you'll get great benefit from it. See ya.